At XSITE Capital, we review hundreds of deals every year. In 2023 alone, we screened 1,748 deals, underwrote 229, submitted offers on 63, and went to best and final on 5. Multifamily investing is not easy, but with the right systems, processes, and tools in place, it's absolutely doable. You can have the perfect deal on paper, but if the location doesn't hold up, whether it's a stagnant job growth, declining population, or high crime rates, you're walking your investors into a risky investment. That's why I created the MSA Multifamily Checklist, a free tool that helps you analyze key metrics such as population trends, economic drivers, and neighborhood safety, to name a few. In this video, I walk you through the checklist, show you how to use it, and explain how it can help save you time on bad deals and focus on the deals that have the most potential for underwriting. Welcome, my name is Manny. I'm an engineer turned pharmacist and a multifamily investor. Over the past 5 years, I've helped XSITE Capital secure over $160 million in assets under management. I'm also the founder of Microshift Analytica, where I help busy professionals like you become savvy multifamily investors. If you're new here, hit subscribe and join us as we share tools and strategies to help you succeed in multifamily investing. The MSA Multifamily Checklist is a step-by-step tool designed to help investors evaluate the quality of a multifamily property's location. It's a framework that breaks down the critical factors you need to consider, including population growth, job growth and economic drivers, industry dependence, crime rates and neighborhood safety, property values and sales trends, future development and infrastructure, tenant-friendly versus landlord-friendly laws, last but not least, school system quality. Think of it as your GPS for navigating location analysis with built-in guidance on what metrics to look for, what red flags to avoid, and which tools can help you find the data. If you're finding this information helpful, don't forget to grab your free copy of the MSA Multifamily Checklist at www.msanalytica.com/checklist. It's a resource we've refined over the years of deal analysis, and it's designed to save you time and help you make smarter investment decisions. Now let's dive into some of the key features of the MSA Multifamily Checklist and why they matter. When you first open the MSA Multifamily Checklist, it's broken up into 3 main sections. The first section gives you a summary of the checklist. The second section gives you a list of all the criteria we look at, and the last section breaks down each of those criteria by the recommended metric that you're looking for, things to avoid, so those are your red flags, recommended tools you can use to pull up data, and the last part is your outcome. You can select either pass, fail, inconclusive, and add any additional comments for your team. The idea behind this checklist is to help you focus only on the deals that meet your criteria. Once you start talking to brokers, they're going to send you a lot of deals, and you simply cannot underwrite every single deal. That is not an efficient process. What you want to do with your deal flow is form a funnel, where once the deals come in, you do an initial screening to see if they meet your criteria. This is where this checklist comes in. You want to check the population growth, the job growth, the median home income of that area, the latest on the crime, property values, and sales trends. You obviously don't want to buy a property in an area where property value is decreasing. Any future developments or infrastructure in that area, is it tenant-friendly or landlord-friendly? Some investors only want to invest in landlord-friendly states. If an area is not landlord-friendly, you can immediately screen out those deals. Last but not least, some investors only buy properties where they have the top school systems. Check for the school quality. By doing this initial screening, you can save yourself a lot of time and only focus on the deals that has the most potential for underwriting. Starting with population growth, you want to look at the historical growth over the last 5 to 10 years. The recommended metric is a positive year-over-year growth of at least 1 to 2%. If you go into Google, type the name of the city and type population growth. For example, if I'm in Los Angeles, I'm going to type in Los Angeles population growth. A chart comes up on Google that can tell you if the population has been increasing or decreasing. You obviously don't want to invest in an area where the population has been consistently decreasing over the past 10 years. Things to avoid: consistent population decline over the past 3 years, significant out-migration. Those are all red flags. Those are areas that you want to avoid. Some free resources that you can use: the U.S. Census Bureau. I have the link embedded in this spreadsheet, so you can click directly on that link to go to the website. Paid resources: you can use CoStar, RealPage, or Esri Analyst. Each of these resources will provide you a lot of information. If you're just starting off, you can get a lot of that information from Google or the U.S. Census Bureau free of charge. Once you do your initial analysis, if it meets your criteria, you can select pass from the drop drop-down menu. If it doesn't, you can select fill. If it's inconclusive, you can select inconclusive, add in additional details if you want someone on your team to follow up on that particular line item. Next, population growth. What are the future population growth for that area? What you're looking for is at least 1 to 2% annual growth rate for the next 5 to 10 years. Red flags or things to look for: flat or negative population growth. Again, here are some free resources you can use. Paid resources we talked about: CoStar, RealPage, Esri Analyst, Neighborhood Scout, and Best Maps. Those are all resources that I've used. Each of these are very useful. It just depends on what your budget is. Migration patterns, that's something you definitely want to pay attention to. This was used by a lot of investors during COVID. You saw a lot of people moving from up north to down south where it was warmer. You want to look for positive migration, more people moving in than out. What you want to avoid is a single employer driving inbound migration. If you're looking to invest in an area, for example, where Amazon just opened up a hub and everybody's moving to that area because of Amazon, you want to be mindful, because if they close that hub, that can lead to unemployment and your tenants moving out of that area. Useful resources that a lot of investors use recently is the U-Haul migration trends. You're looking for one-way movement for these U-Haul trucks. That gives you insight where people are moving to. Select if it meets your criteria, fails, or inconclusive. The three main criteria you always want to check for are population growth, job growth, and median home income. The other ones are important, but these are the three main ones you want to make sure they meet your criteria. Job growth and economic drivers: look for major local employers, at least 3 to 5 sizable employers. That's 1,000 plus employees in different sectors. Avoid towns where a single employer drives all the jobs in that area. I just give the example about Amazon establishing a hub and a bunch of people moving to that area. If that employer closes that location, you're going to lose a lot of tenants. People are going to move to different areas. Things to look into: military towns, oil and gas towns, auto towns like Detroit. These are not hard stops. These are risk factors that you want to analyze. If you like the area and you want to invest in that area for whatever reason, then make sure you have mitigation strategies in case the worst case scenario was to occur. Free resources: local chamber of commerce, some paid resources, CoStar, or local economic impact reports. Some of the sub criteria include unemployment, industry diversity. You don't want any single industry to be more than 25% of the local employment. That's heavy concentration, and it's a risk in case that industry was to leave that particular location. Next, median household income at or above the state average or showing upward trend over multiple years. If you're looking to invest in an area and the median home income is significantly below the state average income with no improvements, then you probably want to avoid that area. Look for income growth trends, at least 2 to 3% annual growth, keeping pace with inflation. Make sure that the annual median home income is at least 3 times the annual rent. The criteria we use here at XSITE Capital is the 3-to-1 rule. The annual median home income has to be at least 3 times the annual rent to give us some kind of comfort that the tenants can afford the rent. You also want to look at the crime and neighborhood safety. Recommended metric when it comes to recent crime trends: decreasing or stable over the last 3 to 5 years. Avoid any area that has a sharp increase in violent or property crimes over multiple years. Free resources you can use include city data, crime stats. The links are embedded. You can click directly on that link. You can call the local police department to get more information. Property values: you want to look for areas where there's at least 3 to 5% annual appreciation in median home prices. Red flags to pay attention to: persistent price declines over multiple years. And you can get a lot of this information from Zillow, Realtor.com, or Truly. These are all free resources. Paid resource: MLS, CoStar. Talk to your broker or RI indicator. Next, tenant-friendly versus landlord-friendly laws. You want to look at the eviction laws, the rent control policies, security deposit rules. For eviction laws, invest in an area where it's at least 60 to 90 days eviction process for non-payment. You don't want to invest in areas where the eviction laws are highly complex or there's an extended process for more than 6 months. That just means tenants are staying in that unit but not paying any rent, and you can't evict them because of the state policies. Rent control policies, that's another area that a lot of investors avoid. Look for areas where there's no rent control or minimum rent control. Avoid areas with strict rent caps, severely limiting revenue growth. Last but not least, school system quality. There's some investors that only want to invest in areas with grade A school system. You can look at school rankings, graduation and placement rates, funding and performance trends. Free resources you can use include include grade schools, the local Department of Education reports, or school board budgets. All of that will give you insights into the school standings and the quality of the school system. Other paid resources include educational research databases or VEST Maps. VEST Maps has information on the quality of the school system as well. This checklist acts as a funnel to help you screen out bad deals so you spend more time analyzing deals that closely meet your criteria and not wasting time underwriting every single deal that hits your inbox. As demonstrated, using the MSA Multifamily Checklist is simple. Start with the recommended metrics for each factor. For example, use free tools like the US Census Bureau or city data to analyze population growth. Cross-check the things to avoid column to identify red flags like declining industries or high crime rates. Record your findings in the checklist. By the end, you have a comprehensive overview of whether the location supports your investment goals. This structure saves you time and ensures you only focus on underwriting deals with the most potential. Download your free copy of the MSA Multifamily Checklist at www.msanalytica.com/checklist and start analyzing locations today with confidence. Now tell me, what's the biggest challenge you face when evaluating multifamily properties? Let me know in the comments below. Don't forget to subscribe and hit the notification bell so you don't miss future videos packed with tools and strategies for smarter investing.